The biggest overhaul of your money you've never heard of? 1. Overview of the emerging monetary infrastructure. Central banks, operating through global coordination mechanisms such as the Bank for International Settlements, are developing a consolidated monetary architecture known as the Single Unified Ledger. This architecture integrates money, payments, loans, property, and financial assets into a shared digital environment rather than maintaining them across isolated institutional databases. The hook is simple but profound: whoever controls the ledger controls the asset. So what does that actually mean? It means that the core record-keeping function, traditionally spread across thousands of disparate systems, moves into one programmable, centrally supervised execution layer. The reveal is that most individuals will never notice the change, seeing only familiar digits on banking applications even as the underlying definition of ownership undergoes structural transformation. Footnote: this section establishes the foundational shift toward a unified, centrally governed digital ledger. 2. The problem with disconnected financial ledgers. Today's financial ecosystem is fragmented. Commercial banks maintain separate ledgers, government agencies maintain their own, and financial markets operate on yet another set of systems. Every transaction, paying for a car, transferring property, or executing cross-border payments, requires verification and reconciliation across multiple incompatible platforms. This fragmentation introduces friction, settlement delays, and failure risk. The unified ledger promises immediate settlement, reduced costs, and consolidated accuracy. From a governance perspective, the single ledger becomes the institutional source of truth, centralizing informational and operational power. Footnote: this section identifies the operational inefficiencies the unified ledger is designed to solve. 3. The central bank's expanded role. Central banks presently observe only what private banking institutions report, often with delays. Under a unified ledger, the supervisory authority gains real-time visibility into transaction flows, system stress points, and asset transfers. The tease here is important: real-time oversight is not merely an efficiency upgrade, it is a redefinition of institutional control. This shift transforms the central bank from a referee managing settlement rails into the operator of a shared digital substrate. So what does that actually mean? It means the central bank sets the rules, validates the transactions, and ultimately determines the conditions under which assets exist, move, or are restricted. Footnote: this section explains how the unified ledger consolidates regulatory and operational authority within central banks. 4. The tokenization of money and assets. To operate within a unified ledger, money and financial assets must be re-expressed as digital tokens. These tokens enable programmability, interoperability, and smart contract-driven settlement. Pilot programs in major economies involve tokenized deposits, tokenized short-term government debt, tokenized mortgages, and wholesale bond settlement systems. The mortgage market itself is being positioned for fractionalization, enabling mortgage obligations to be sliced into smaller units and traded for yield. The reveal: once assets become programmable, the system, not the individual, defines their behavior. Footnote: this section details the transition from traditional balance sheet entries to programmable digital tokens. 5. The principle of singleness of money. Central banks articulate a principle known as the singleness of money, meaning that all tokenized forms, central bank money, tokenized deposits, stable coins, or tokenized sovereign debt, are fully interchangeable at par. This standardization allows banks to sweep customer deposits into tokenized government debt, generating immediate yield while leaving the front-end customer interface unchanged. So what does that actually mean? It means your digital balance may no longer represent bank deposits alone, but a dynamic blend of assets whose composition is invisible unless queried specifically. Footnote: this section clarifies the interchangeability of monetary instruments within the unified ledger. 6. A self-reinforcing system for sovereign debt. The unified ledger effectively strengthens sovereign government debt as the backbone of the financial system. By embedding sovereign bonds into the transactional architecture, the system ensures built-in demand for government debt, reinforcing its central role as collateral. Programmable capital controls could restrict exit routes during financial instability, thereby preventing the traditional flight to safety. The empathy moment here is clear: individuals believe they hold money, when in reality they may be involuntary participants in the absorption of government liabilities. Footnote: this section shows how the unified ledger structurally reinforces sovereign debt demand. 7. Composability and irreversibility of entry. A core feature of this system is composability, the ability for all tokens to interoperate. Tokenized deposits can buy tokenized equities, tokenized bonds, or other tokenized financial instruments. However, redemption requires permission through authorized intermediaries. Tokens cannot simply be removed at will, meaning withdrawal from the system is structurally constrained. This introduces a subtle but significant shift: the individual no longer holds the asset directly but holds a digital representation governed by the system. Footnote: this section explains how composability increases functionality while limiting true exit options. 8. The power structure of ledger governance. The defining question becomes: who controls the ledger? The answer is unambiguous: the operator of the ledger controls the asset. This grants central banks unprecedented leverage to define valid assets, enforce compliance, and integrate programmable conditions into the financial system. So what does that actually mean? It means taxation, penalties, spending restrictions, and compliance obligations could be automated through code rather than policy. The action step is recognizing that programmability alters the very definition of ownership, transforming assets into revocable or conditionally accessible digital claims. Footnote: this section identifies the fundamental power implications of centralized ledger governance. 9. Regime preservation rather than systemic reform. Despite the technological sophistication, the unified ledger does not create debt-free money, eliminate bank credit creation, or redesign the monetary system. Instead, it modernizes the infrastructure supporting the existing debt-based regime. The ledger makes it easier to channel retail funds into sovereign debt instruments and enables algorithmic bail-ins whereby public funds can support financial institutions during distress. The suggest component emerges here. Understanding this architecture is essential for anticipating how future monetary policy will shape access, ownership, and financial autonomy. Footnote: this section emphasizes that the unified ledger reinforces, rather than replaces, the existing debt-driven system.